Hi, this is Randy Finney with Right Side of the Chart, and this is a midday update for Friday, May 1st, 2020. It's 12:30 p.m. Eastern Time as I'm starting the video. Wanted to do a quick update on the broad markets and take a look at the semiconductor sector because I added that back today as an official short trade. Still think it has some of the best potential as far as sectors. It's a subsector of the technology sector, and technology is the largest sector of the Nasdaq 100. Semis are often considered, a canary in the coal mine, if you will, for the tech sector as a whole. So, as I often say, when tech breaks, the market breaks. It's that simple because technology is the largest component of both the S&P 500 and especially the Nasdaq 100, coming in about 25 and 50% respectively of those two indexes. All right, so what do we have today? Well, we had the whipsaw signal the other day in QQQ. Remember, low volume, not confirmed by breakdowns in majority of the other sectors or indexes. And again, earnings week. So like I said, I took everything over the last week with a giant lump of salt, not a little grain of salt, a big lump of salt. And we're done now. We as of last night, we have all five fangs out of the way. The last of the two reported. We had Amazon and Apple reporting last night. Yeah, was it Amazon and Apple? Yes, yes. So those are all out of the way now, and let's take a look at the chart. So what do we have? Before the close, we had a unimpulsive breakdown. You want to see breakdowns impulsive or any follow through after that. So we had a breakdown there, non-impulsive, held support there, that 2196 level, and that's where we're at now. So I wanted to point out we are at support, but we do have an impulsive move down. A gap is about as impulsive as it gets. You're not going to see a big red line through there, a big red candle. Why? Because there's a gap. It's a void, but it is essentially, a big red line down through there. If you put a line chart, that's going to go down like that, straight down. And so again, nothing's more impulsive than a gap. And I really like them, especially when you look at the SOX trade, for example. Why do I like gaps when I'm, looking shorting an index or a sector or a stock? Well, because you have, first of all, bulls were foaming at the mouth recently. Has been a strong uptrend, and look, let me say this: it's not over yet. Today is a down day, but it's just a little pimple on a giant mountain of a rally. There's quite a bit of work to be done to firm up the case. It looks good so far, but if they come in and do this in the next day or two, today's Friday, so you've got to remember, no matter what happens, you're going to have to make a decision as to how you want to go home positioned, and we'll see that, and that'll kind of give us maybe a little tell in the market. If there's a big rally into the close, maybe most people are optimistic. There's more willing buyers on the sidelines, dip buyers, whether it's buyers plural or one buyer, the Fed, that's doing most of the lifting at this point. It doesn't matter really. Stocks rise and fall on supply and demand forces. So when there's more buyers, again, more demand, stock price is going to go up, or security. And when there's more sellers or more supply, prices go down. It's really that simple. There's no other in between. It's a matter of who the buyer is, how, what their convictions, what their intention is. Are they algos, high frequency trading, just in and out real quick, riding the trend, or are they longer term buyers that plan to hold these securities and ride out the zigs and zags? So that's all yet to be seen. All we can do is just look at the charts and take them on face value. So where I was going with the gap down thing is, what it does is, when you have an uptrend like we have here, you have obviously a lot of shorts being squeezed out along the way, especially when you get towards the top of an extended run. You have a lot of new buyers pile in, and so what it does is it tends to deny those that want to be short the semis an objective entry, because we didn't break down through here with a buy trigger. Anybody had an alert set ready to short a break of the trend line, well, guess what? They had to make a decision this morning on the semis from where they closed and opened. I don't know exactly where we're open, somewhere in here. They want to chase a 4 or so % gap down. I know some traders just by nature won't do it. I don't have any problem with it. I used to now say, no, I wanted to I'll wait for a kickback rally, and that's the other thing. So where I'm going with this is, when you have an extended run, it tends to trap a lot of longs that also, for the same basis, they had a stop set just below that level, and then we gap down. So what they say, and again, I'm just kind of speaking generically trying to get in the head of longs because I've been on both sides of these trades. Well, a long might say, "Oh man, that's a big gap. I've been doing real well. I don't want to cover right now or stop out of my long trade because I'm down. Semis are down 4%. I'll wait till it kick back. We'll backfill that gap for sure. Come back, test the trend line, and then maybe that's where I'll get out or I'll watch it and see if it rejects there." Well, when you keep going down like this, that's quite bearish because you have those longs trapped and they start to feel more and more pain. And you also denied a lot of shorts an entry. And why do I like that? I like being the only guy short a stock, ideally, or an ETF, because the more shorts you have, higher the short interest, the more guaranteed buyers. I always talk about that in the market. The only guaranteed buyers in the stock market, it's not the Fed, it's not a hedge fund, a mutual fund, it's a professional money manager, it's not an individual investor. It is a short seller, someone short a stock. They are the only guaranteed buyers of that stock. What do I mean by that? Well, they have sentiment surveys, polls that go out every week. AAII, that's the American Association of Individual Investors, and they poll them every week as to are they bullish or bearish on the markets. Those results come out every week. So let me just say this. So I might be bullish on the markets and very bullish, saying yes, I think the markets are going up another 20%. I view any pullback as a buying opportunity. I plan to buy. I've got a lot of capital I plan to deploy into the market. But guess what? That's rhetoric. That's talk. I may change my mind. Something may come up, and I don't have to buy. A short seller must buy. When you short a stock, you are borrowing somebody else's stock from your broker, someone who's long that stock. Their broker is turning around, lending you their shares, letting you sell them first, but you have to close that position. You have to buy it out. So that's why heavily shorted stocks have those explosive short covering rallies. The more shorts you have in there, and it also at some point slows a descent down when a stock is saturated or heavy in short sellers. There's no more short sellers left to short, if that makes sense. There's only a certain subset of traders and investors and hedge funds that short. Most people only go long stocks. And just like where stocks end on a rally, a bull market or a strong rally ends when the last bull has bought his or her last share at that point. And again, kind of metaphorically speaking, because what happens, the supply dynamics shift over at some point. After a very strong bull run, everybody's bullish, everybody's long. If you've already got, you have $100,000 portfolio and you've got all the Apple you care to own, you're not going to buy anymore, and the guy next to you isn't. So that's how those things work. And again, I'm kind of speaking bigger picture here, but I just want a near-term picture saying that I think it's very safe to assume that short interest has a lot of that's been cleared out recently, and a lot of folks have been drinking the Kool-Aid, have been buying back long, thinking that because we've seen an abatement in coronavirus, or I don't even know so much expectation of an abatement, I guess is the word, or maybe there's some other things, but also, cures, promising drug trial, all that stuff again that's been priced in was expected. I always said that coronavirus isn't going to, continue to lock down the global economy forever. So it is now turning to what I've talked about for the last couple of weeks, and we're seeing that now. A focus is turning to, okay, all right, we know what happened last quarter, earnings out of the way, what's going to happen going forward? And you're seeing that today. You're seeing companies like Amazon that blew the cover off the ball, and they're being sold. And this is where I think a lot of investors and traders struggle. How can Amazon come out with their best quarter ever, blowout earnings, whatever it was, and yet the stock is down? And it rallied after hours, but it's down. Well, because everything you're looking at right here, this move, you have to ask yourself, how much of a 51% rally in just over a month in a $1 trillion company, that's almost unheard of, how much of that 50% rally was already pricing in the fact that we all knew, of course, Amazon sales are going to go up. I talked about it back here. Everyone was on lockdown, so they had an increase in sales. But there were the other factors in play that I had talked about, and some others on the site. They're going to see increased labor costs, sick employees calling in sick from coronavirus, worried about it. Others that new hires they had to train, shift to lower margin items, and all that kind of good stuff. So that's it. It's called buy the rumor, sell the news. Okay, I had to pause the video there, take a phone call, but I'm back on track here. Trying to remember where I left off, but I just wanted to touch on Amazon because, of course, that's one of the largest companies, top weighted component in the indexes. So just to kind of update, there's the uptrend line broken. Earnings are out of the way. So like I said, green lights across the board for breakdowns. And here's the thing. If these breakdowns should stick by all accounts. Somebody had asked under the SOXX short trade idea today, hey, why was your stop? Let's talk about that real quick. Why was your stop, why was it set just above or just below the previous reaction high? That makes sense, right? Most traders say, well, if the previous reaction high is taken out, that's a pivot point, and you usually get more buyers. Number one, you can check out my response. It was just this. Many, many years ago, I used to do that quite often. Not on every trade is different, but a lot. And I'd noticed that a lot of times, almost more often than not, you see these get close to those previous reaction highs, they run at it. It's the algos. Algos are algorithmic trading programs. You also have the old school market makers, not market makers, those two, but you have traders that can either sense. It doesn't take a rocket scientist to say that if people that are shorting stocks, a lot of them probably have a stop a little bit above there. And not only that, but guess what? Your broker's selling your order information to these trading firms with the algorithmic and other trading programs that so they can see exactly where those stops are. So that's why explain that's one of the reasons commissions have went from expensive to cheap to zero in recent years, because most brokers are selling your order flow. That's where they're making a good part of their money, and that's part of the reason they're able to give you 0% commissions on a stock. So therefore, I don't want to stop right here just above that level, because if you do pop it, you're going to have a flood of orders getting hit all at once. So when you have a lot of sell stop orders, those are buy stop orders. When you're short, you sold a stock, you sold short. And when you have a stop loss, it's a buy to cover to close out your position. And you also have the natural buyers that will come in and buy when a previous reaction high is taken out. So I did that, number one, for that reason. And number two, it's also based on a risk-reward ratio. We entered somewhere around here. I usually like a 3-to-1 or better. Sometimes I'll do a 2-to-1 or better risk-reward ratio. There's about a 15% drop if our third target's hit. And if we're stopped out, then that's about a 6% loss. So almost a 3-to-1, a little less than a 3-to-1 risk-reward ratio. That also went into my calculations and factoring. And then finally, this breakdown, by all accounts, looks legit. This is 110% what you want to see. The gap down was impulsive. The follow-through move so far was impulsive. And based on, again, it's just instinct, years of doing this, that where I think the market is, I think a lot of shorts, bears have capitulated recently, and therefore, if that is correct, and you have right now, a lot of trap longs and shorts that were waiting or still are waiting for a back test, and they're not in this right now, I think that paves the way for an even increases the odds we're going to continue lower. So where I'm getting at is, at best, I can tolerate and can see a back test. I don't expect it to happen, but it could happen and still very well keep the this case intact from a technical perspective. I'm talking about a back test here. There's also a gap right there. Let's say we do back tests and we come in and also backfill the gap at the same time. Those are two very obvious places where, quote unquote, SOX should reverse if it gets to. I think a lot of traders are probably hoping to see that now. Both longs maybe get out there and shorts get in there, and that's why I don't think it's going to happen. But if it does, it keeps the trade intact. However, take out the gap. If you backfill the gap and move much above it, that's not bearish. That's bullish. To backfill the gap is normal. To take out the gap and keep going is not. So I think if we take out that gap, it opens the door to new highs, and that's why I'd rather stop out a little shy of that new high. But it's also on a daily close. I mean, that doesn't guarantee. And I'm doing this because if you've seen, we've had quite a few trades. I've done that too, and we've stayed in the trade. And I have already, in case of both SPY and LQD, recouped back what would have been locked in guaranteed losses. We've recouped back some of those losses. Those two trades in particular haven't gone positive yet, but I suspect that they will. And that's why, and had we not done this on a daily close, because the markets are volatile right now, and that's a field day for market makers, algos, and all that to run stops intraday only to see those securities reverse. So that's why I'm using and preferring these stops on a daily close right now. I'm an adaptive trader. I adapt to different market conditions. Done this in the past, and and I think at this point in time, it favors those type of stops. The downside is, you can run through 240.70 and on a strong day and keep going. So like I always say, use stops that are in line with your own risk tolerance, loss allowance, etc., as well as trades. If you don't believe the market's going lower from here, or you don't like trading volatile indexes like semiconductors, this is not your trade. If you do, and you want trades that have, I think, a sector, for example, that has more meat on the bone for a short than the overall broad market, then I think this one's for you. That's it. So I'll leave it alone and move on to the next one here. Quick update on SPY. SPY is at support stops, as of now, or every day. If I pull a stop, if I suspend it, it's for that day. We've suspended it through yesterday so far, reinstated the next day unless otherwise stated, unless I get a video or a post out saying that I'll update it or suspend it again. So as of now, it's reinstated. And again, if anything changes by the close, like for example, if we come right back up here and we run at, now that's the bottom, that stop, that's the same stop we've had here for weeks, happens to be, coincidentally or not, the exact bottom, or damn close to the exact bottom. Let's see, the high was 286.04, 286.08. So it's essentially the bottom of the gap. So where am I going with that? Well, if we bounce here, we're at support right now. I'm going to show you we're at support on the futures too, 281.48. We could bounce here, maybe not. I think a lot of people are trapped, so I expect any bounces. Just like I said this morning, I expected a reaction off the initial tag of that support level on QQQ. And we got it, and it was minor, which is what I expected, and then we continued lower. But if we bounce here, that's going to be resistance right there. And so who knows, maybe we close up there slightly in the gap, slightly below it. So that's what would have me suspend. If we come up here today and we enter the gap and we backfill the gap and we even take out the top of the gap, which is right here, that tells me there are just strong supply demand forces in this market. Again, whether it's natural buyers, hedge funds, mutual funds, pension plans, individual investors, and or Jay Powell, the almighty Jay Powell, and the Fed doing most of the buying right now. It doesn't matter really. It just means there's more buyers than sellers. So that point, I'll probably let this trade go if we see some kind of crazy turnaround like that. It's Friday too. Keep that in mind. Anything can happen over the weekend, and I'll be interested to see how the market trades. And at the end of the day, and especially into the close, you're going to see a dump into the close, saying there's a lot of scared longs that want out, shorts want in, or are you going to see a big ramp into the close, saying dip buyers or whatever? If we're down heading into the final hour of trading and there's a huge recovery. But again, don't put too much on those end-of-day moves, because that's just a lot of ETF and mutual fund positioning. They have to square their positions away at the end of the day. But it's worth watching. It'll be interesting if there's something glaring that stands out. So that's it. SPY's down at support right now. Big divergent high. And let me just be clear, I'm talking about all these little micro calls and things I think may happen and what I'm looking for. But this is to just take a step back. If you're not an active trader, this is just a big bearish rising wedge pattern, a uptrend line off the lows, and a breakdown. This pattern projects or measures the widest part of the wedge added to the point it broke down. So that measures down to about probably my second target, at least my first target down there. So it'll be very clear from all these little zigs and zags aside, unless, like what I said, something bullish happens here. I wouldn't get cute if you're not a, if you're not a very active trader and try to game any counter trend bounces, because I think at the very least here, we would hit that measured target, and that's about another 6.5% or so down on SPY. Let's look at QQQ, and then we'll look at the futures. QQQ at support, same level I've had here for a while, same level that contained that false whipsaw signal the other day, 211.96. So this morning when I posted an update, we broke gap down, hit that 214. These are the same levels that were on this chart for the last several days at least, if not week or so. 214.56. I said I expected a minor reaction. That's it. That's a bounce from that support level. Up here, that's about a 1% bounce. An active trader could have gamed that for sure. And then I also went on to say I don't think we'd make a full backfill of the gap. I said if we do, that would be the uppermost bounce target, but I suspected we'd fall short. Why? Well, for many reasons, but so far, my kind of feel on the market is correct that a lot of people are trapped. So that was such an obvious target. So you probably had a lot of shorts saying, I missed that move on the gap down day, but I'm going to short that back test. Well, guess what? This is what Mr. Market likes to do, and I'd like to see this kind of thing continue. They deny shorts an objective entry. Didn't get close enough to get there, and it didn't allow longs that said, oh, shoot, I think these trend lines are broken. I don't like what I'm seeing with Amazon after earnings and all this other stuff, so I'm going to get out, but I'm going to wait. I'm not going to sell here down so much. I'm going to wait for a back test and then get out. Well, you were also denied. So that strengthens the case for more downside. Like I said, trap longs and wannabe shorts that were so far denied an entry. And simple, bounce off that's why these levels are here. Trade them as you want. Doesn't guarantee you're going to get reactions, but so far we did. So that's how it works. Breakdown, back test of the wedge, gap down, hit for support, get a reaction off the initial tag of that support. Hit the second support, which we just did, 211.96, but so far a more muted reaction. Here's something else that we can see. So now those that are getting burned here, see, this is starting to play out so far. Our bounce at this point, and we could go higher. We're still above that level. There may be more of a reaction to come. Only about a 0.6% bounce. Maybe 0.5% or so off that initial tag of 211.96, and still a big level. We've had it was saved us right here. It saved the Qs, I should say. And if we break down, I could probably put a few minor levels in here, such as extend this line. But to be honest with you, there's really not a lot there. I think if this level goes to 11.96, I think that opens the door for a move down here to that 203.29, and this level here, I should point out, it's about 207.50. Again, there's a gap right here. Another gap, two gaps. So that's a level that should be noted here. I'll put it up so you can see it there, 207.50ish. And then at the end of the day, as far as timing, if you're trying to add to a position, whether you're long, like I said, if you're a bull, nothing would be better than to see this breakdown reversed and go up. So if you're bullish, think the market's going to go to new highs, thinking these divergences will not play out, then here, you had an opportunity to buy. You have an opportunity right now. Buy at support. You can put a stop not too far below and just trail it up and see if you can, if this market can shrug off these divergences and run at new highs. This trend indicator is still bullish for now. Certainly a possibility. So there's work to be done here on the bearish side. And again, these are levels that, right or wrong on where we go, I can do a pretty good job of identifying the important levels that you're likely to get a reaction on. And so therefore, like I said, you can trade accordingly. As a short seller or a bear, is it objective to short here? No, because you're at right above support. At this point, the most objective entries would either be a bounce back to resistance, maybe a backfill of that gap, or even that 214.56 level, or a break down below the 211.96 level. And the futures, this is NQ NASDAQ 100 futures. Here's that trend line I've had here for a while now. Uptrend line which we broke recently in the overnight or early morning session here. First we had a sell signal here. We put in this divergent high, this broadening wedge type pattern, divergent high right there. Negative divergence started to play out. Sell signal 1, breakdown, back test. Came on here, hit that trend line I've had here for a while. Danced on it for a few days, or I'm sorry, a few hours. These are hourly candles. Breakdown, back test, just beautiful technical analysis, the way it's acting off these levels here. And so we're back to, I've talked about this one quite a bit recently, 86.90. That's a level that has acted as support and resistance quite a bit in recent weeks here. So it's been resistance. Resistance once broken becomes support. Support once broken becomes resistance. Little whipsaw there, but you can see. And then support as well as this trend line. So that's it. We need to break these lows. I suspect we're going to do it because of, again, I think that, like I said, we have some pretty solid breakdowns. And if we don't, like I said, that's pretty darn bullish. If they can shrug off these breakdowns, these technical bearish developments here, and power on up, then boy, you got to give it to the market forces, whatever they are, driving this market higher. So that's why. Still favor this scenario. I'll be very clear on that, but I'll certainly respect this and adjust accordingly if it happens. And just like QQQ, we are at support, so we need to take that level out. So far, we've had a reaction. If you zoom in, it's a reaction more so in time, meaning consolidating, trading around right on that level more so than in price. Not much of a bounce. This was that bounce in the Qs this morning, and that just took us for a back test of the trend line, that blue trend line right there. Let's look at ES. ES, same story. Everything that was laid out recently. That's why the charts were pretty much pricing in which way Amazon and all these companies will go after earnings, even regardless of their initial pop. I always say that. Don't put too much into the initial reaction of a stock after they report earnings, whether it's that after hours or early or pre-market session reaction, or even the following day. It sometimes takes a day or two, even up to a week, for the market to kind of fully digest that, those earnings. And so far, we're seeing a lot of those FANG stocks that had initial pops they're fading those rallies. So what do we have here? Divergent high, just like this divergent high with a correction, divergent high correction. These things do work more often than not. Nothing's guaranteed. And I wanted to point out I've added, since the last update here, the only other line I've added to this chart, I believe, is right here, this downtrend line to watch. Potential downtrend line. We could pop it. It's new. It doesn't have a lot of reactions, but that's what's keeping us going. And just like the Nasdaq 100, the S&P 500 is at support 2819, 2819.50ish. More of a support zone down to about 2806, and that's where we're at right now. So that's why the markets have stalled out here recently. We hit support, pretty good support. Whether we bounce or not, if we do, that's the first overhead resistance level. You know what? I'm going to move that line down now. That's a better fit. That's resistance about 28.55. Going back, and break down below this level should open the door to bring us down here. And then kind of the bigger picture, I'm going to just jump back here, go out to a few months. We're at 1 month of price history. I'm going to show you one thing. Bigger picture to me is this. Remember, we had this multi-week sideways trading range. We broke out recently. And now it is, as I suspected it would be, a false breakout, failed breakout, bull trap, whatever you want to call it. I mean, we popped that multi-week trading range and we've moved impulsively back down into it. That's a failed breakout. That's bearish. I think at minimum we head back to the bottom, test the bottom of that channel, and could possibly break on down through it. Leaning that way. Whether we get a reaction, we'll just have to assess the charts as they come. But I do want to point out bigger picture stuff. Multi-week consolidation range where the rally kind of stalled out, broke out. Yay, 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 right, for the bulls. But no, now it's a kind of a knife through the heart because that breakout has failed, and that's a bearish technical event. And on NQ, let's see what that looks like. Because NQ, even though it's not as diversified, it's not as representative of the economy as the S&P 500, it's more important to the stock market because it's chock full of those market-leading tech stocks, the FANG stocks. And so same story here, multi-week consolidation range, failed breakout. Let me move this thing here. There's your little false breakout and a breakdown now. So like I said, nothing but bearish check marks across the board over the last few days. First with the reversal off the divergent highs, trend line breaks, failure back into those multi-week trading ranges, and still anybody's game if we go back down to it. But again, I'm not going to spend any time talking about the long-term charts now, but the long-term charts tell me this still has been nothing more than a bear market rally, and if so, then that's why, ultimately, whether we bounce here or not, I favor more downside. And the small caps, just a beautiful little setup recently. We had that divergent high, negative divergence, as I covered recently, building on the PPO, then finally put in that divergent high on the RSI as well. We had a nice clean little uptrend line in which to trigger a sell signal right there. That was yesterday, I think, and so far that's good for about a 7.3% drop in RTY. These are small cap futures. If the RTY is too big of a contract size, M2K is the exact same thing. It's the EMIT, but the minis. So they use a smaller leverage factor, same exact price levels. And I'm going to give you one more potential target here for those of you in this one, right about there. I see some reaction highs. And that's where we're at now. So here's the common theme as I wrap up this video. The NASDAQ 100, S&P 500, and QQQ are all at support levels. Support levels they should, again, quote unquote, they should bounce off of. Buyers should step in. This is where the dip buyers should show up, and if they don't, it tells you that there's been a change now in the supply demand dynamics, meaning there are more willing sellers than willing buyers at this point in time, especially if they don't come in and buy up this that's a pretty nice support level, as are those other ones I just showed you on the S&P 500 and NASDAQ 100. So whether we bounce or not, like I said, any bounce I think would be relatively small. There's overhead resistance levels in which you can short or add to short positions, such as 1263 on RTY with us. Maybe you could put a tight stop above it, give it a little more room is what I prefer right now. Because of these breakdowns. That's how you have to trade a volatile market too, guys. Tight stops are just going to get you taken out. If you don't have the gumption for it, either stand aside, or my suggestion always is to take a very small position size. When you have markets that swing 3, sometimes 4 or 5% a day, like we have for the last few months, and can move up and down 10, even 20% or more in a couple weeks, guess what? You don't have to have, and you shouldn't have, the same position size that you had a year ago, 2 years ago, when the indexes were going up and down maybe 0.5% a day, and it took months for the market to go up or down 10%, whereas now it's doing a lot quicker. So the easy way to sleep at night and not get feel a lot of pain when these trades start to go against you is to not put so much. Instead of buying 100,000 or 10,000 or 1,000, whatever your number is, cut that number down substantially, and at the end of the day it's still worth it, because you can take a half position size, because right now the swing, the gain potential and loss potential on swing trades is double or more what it normally is in a normal market. So it's all relative, if that makes sense to you. And so instead of a $10,000 position on QQQ, a $5,000 position will allow you to use a larger stop loss in percentage terms, but still not take any more of a loss in dollar terms, because that's what's important. That's what will kill you. And also then if that trade plays out, you're going to have a much larger gain potential in percentage terms, so it's worth it. We'll wrap it up here and get this out to you, and if anything big happens before the close, of course I'll do an update. I'll probably do an update anyways, and I'm going to try to sniff out some additional trade ideas for you guys now. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.